Choosing the right interest-only mortgage. There are several things to consider when choosing an interest-only mortgage. First, you need to decide if you can afford the payments. Interest-only payments are typically lower than payments on a traditional mortgage, but you will need to be prepared to make the larger payments when the interest-only period ends. Second, you need to consider how long you plan to stay in your home. If you think you may move within the interest-only period, an interest-only mortgage may not be the best option. Third, you need to compare interest-only mortgages with traditional mortgages. Traditional mortgages typically have lower interest rates, but you will have to make principal and interest payments from the beginning. Interest-only mortgages typically have higher interest rates, but you will only have to make interest payments for the first few years. Fourth, you need to consider the risks associated with an interest-only mortgage. If you are not able to make the larger payments. Factors to consider when choosing an interest-only mortgage. When choosing the right interest-only mortgage, it's important to consider several factors to ensure it aligns with your financial goals and circumstances. Here are some key points to consider. Number 1 is loan terms. Understand the terms of the interest-only period, including its duration and when the principal payments will begin. Typical interest-only periods range from 5 to 10 years. Consider how long you plan to stay in the property and whether you can comfortably handle the principal payments once they commence. Number 2 is interest rate type. Determine whether the interest rate is fixed or adjustable. A fixed rate provides stability and predictable payments, while an adjustable rate can fluctuate over time. Evaluate your risk tolerance and assess whether you can handle potential interest rate increases with an adjustable rate mortgage. Number 3 is total loan term. Consider the overall loan term, which includes both the interest-only period and the subsequent principal repayment period. For example, if you have a 30-year loan term with a 10-year interest-only period, you will be paying off the principal for the remaining 20 years. Evaluate whether the total loan term aligns with your long-term plans and financial capabilities. Number 4 is lender requirements. Research different lenders and their specific requirements for interest-only mortgages. Understand their eligibility criteria, down payment requirements, credit score expectations, and any additional fees or costs associated with the loan. Comparing offers from multiple lenders can help you find the most favorable terms. Number 5 is financial stability and future plans. Evaluate your financial stability and future plans. Consider factors such as your income trajectory, potential changes in employment, and your ability to handle potential increases in monthly payments once the interest-only period ends. Assess whether an interest-only mortgage aligns with your short-term and long-term financial goals. By carefully considering these factors and seeking professional advice, you can choose the right interest-only mortgage that aligns with your financial goals and helps you manage your cash flow effectively. Seek guidance from a mortgage professional or financial advisor who can provide personalized advice based on your specific circumstances. They can help you evaluate the pros and cons of an interest-only mortgage, assess its suitability for your situation, and guide you in making an informed decision.